One. Hello, everyone. This is Gary Wilson, and welcome to Real Estate Investing for Professional Men and Women. Welcome aboard, chiropractors, dentists. You're an engineer, you're a pilot, possibly military, maybe teacher. These are all the groups that tend to be attracted to this podcast. And the reason is it is somewhat unique because I'm not preaching the no money down or financing stuff. I'm not saying it doesn't work. I did it for years. It has its place, but it's not the only way we buy and invest in real estate. Okay, there's certain strategies that I used in the beginning, and then I did a lot of cash purchases, and then after that I was able to use other creative strategies that basically allow me to borrow strategically against the assets, putting me in control. And that's what I want you to do. Okay, I mean, chances are you've been practicing for a while, and you're starting to think, what am I going to do when it's time to retire? My practice is my name, and well, there's ways you can overcome that, and basically keep your practice if you want, but more importantly, leverage it to invest in passive income real estate, rental real estate, so you don't have to be stuck behind a chair. We do invest ethically and honorably in our areas where we're all about growth for the environment that we're in, for our renters, for us. It's win-win for everybody. And we absolutely leverage everything we're doing, including our existing practice. So anyways, if you haven't yet subscribed, this podcast is on 75 different channels, I believe. You can go to Stitcher, iTunes, iHeartRadio, whatever you prefer, and subscribe there. And if you like the idea of being in the community, remember, we've got professionally trained real estate agents trained to work with us investors all over the lower 48 states and 3 Canadian provinces. And their training is focused on us helping, flipping homes, buying fourplexes, things like that. It's unique. You're not going to find them in the commercial world. You're not going to find them necessarily in the residential world. These are unique type of agents, and we connected with them and the appropriate service providers that you need to help you succeed. So in any case, what I want to do today is introduce you to a fellow mastermind member, Stephen Hatcher. He's in Greensboro, North Carolina, has his own practice, does invest, and I want him to share his story with you so that you can see a little bit of him in you and perhaps get you in the game finally and start investing and leverage your practice and give yourself some breathing room down over here. So Stephen, welcome aboard, man.
Hey, great to see you, Gary.
Hey, so without me, if you don't mind, I'd rather have you kind of describe yourself. People are probably wondering, some people might know you, by the way, if they're in the Triad area, but for those who are in Wyoming and California and everywhere else in Canada, if you wouldn't mind, just tell us a little bit who is Stephen Hatcher, maybe a brief background, how you actually got started in your practice, what led you to that, and then maybe talk about the fact that you do invest, and we'll get into some examples a little bit later.
Oh, sure. Well, who am I? I would say that's relatively easy to define. I'm a father, son, husband, dentist, and those orders of importance. So that's sort of who I am. My story, I grew up with my father worked in both my parents worked in factories, and my dad had amassed probably about 20 up to 20 single families, at one point in his career. And I saw firsthand the challenges of property management. And I realized along the way that, gosh, it's a lot of work. And he was, when there were tenants that were out, he still had to get the property turned and work his job and do all those sorts of things. But one of the things I've realized throughout the years is that they really missed out on scale because they weren't in the right rooms. And I was talking to them all the things that I've learned over just the past, 5 or 6 years, all the things that they could have done. And I was talking to them about, professional property management, scaling, because there's only so many single families that one person can manage, and where they're collecting the rent and doing all that kind of thing. Mm-hmm. And, their jaw dropped when I was talking to them about some of the concepts, some of the things that they could have done, but it's too late now, but they could have sold those 20 properties as a portfolio, rolled that over to an apartment, and kept on rolling up, because they never sold because of taxes. Mm-hmm. and their jaw dropped, and my dad's undergoing some health problems right now, so they finally delegated it to a professional property manager who screens tenants and collects rent for a living.
Mm-hmm.
And our world, so my mom can concentrate on helping my dad now. It just made a world of a difference. But I started with like a lot of people, reading the Purple Book, Rich Dad Poor Dad. And I was like, man, these concepts sound really good. And I was just so busy professionally, professional education, being in school, and getting out there. I was in the Army for 4 years, and they paid for dental school. And took over a practice in 2008 when a guy was ready to retire, and I was just knee deep in the practice, and a lot of people think that they own a business, but most people just own a job. What I mean by that is that if you weren't working, it wouldn't continue without you. So reading Kiyosaki and the 4 quadrants that he talks about: employee, self-employed, business owner, investor. I thought I was in the S quadrant, but I was probably technically in the E quadrant. So, I was slowly trying to, get over into the B quadrant, get the practice to run when I'm not there. And I accomplished that through lots of coaching. And, I'm getting more and more into the I quadrant where, my money, capital works for me when I'm not working. And, one of the things that happened was one of my patients was an apartment developer. And I remember Kiyosaki talking about, having, other things support your lifestyle, like, apartment building or something like that, doors, paying for your door that you live in. And anyways, it was about 2010, and he was building an apartment complex, and they raised some money in something called a syndication.
Mm-hmm.
And we all pulled our money together and built I don't know, it was like probably 200 doors. And a couple of years later, it was 90% occupied, and we got 40% of our initial capital back tax-free, and then rolled it into another property and just kept doing that over and over and over. And I still worked, but I kept owning small parts of of larger properties. And then one day I looked up and I had like a lot of cash flow coming in from all the real estate that I was buying. And I was like, hey, this makes a lot of sense. And then I started to study it, more and more. And I haven't looked back since. Now, one of the things that you said at the very beginning of the podcast is that, some people try to do the no money down. I think your audience is in a different group. It is possible to do that. I've never done it that way. It's a lot of work. It's a lot easier, if you have a high income and you have funds to invest. It's a lot easier, a lot less brain damage if you're in the right rooms.
Yeah, I agree 100%. When I started investing, this is going back 30 some odd years now. My gosh, it's been 33 years. Holy smokes. Back then it was the mid 80s, and interest rates were still extremely high, and everybody was doing creative purchasing techniques because borrowing from traditional lenders was just almost cost prohibitive. So that was how I cut my teeth. And I just thought, well, that's how you invest. I didn't realize, hey, it's okay to put money down. So in any cases, I personally built up equity and cash flow. I realized, man, I'm going to use money, actual cash, because I'll get better deals.
Right.
I can still borrow against the asset later on if I want to raise more capital, which is exactly what I did. But you're spot on. I got to tell you, everybody listening here, man, Stephen hit the nail on the head. Just because all the late night gurus are teaching no money down, it doesn't mean it's the only way to invest. In fact, the reason they teach that stuff is they're catering to the crowd that says to themselves, I don't have any money. So they say, okay, we're going to give you some no money down techniques. Doesn't mean they work. They work very poorly. Like you said, Stephen, a lot of work. I mean, you got to kiss a lot of frogs to get that prince. But man, when you go in with a cash position, you get to basically name your tune, So I appreciate you saying that and bringing that up. If you could do me a favor, I want to go back to so you got your degree, you built your practice. I mean, chances are you may have worked for somebody else first, but eventually built your practice. Describe the first deal you did, if you don't mind, in real estate investing. And if you can remember what that felt like before you signed and what it felt like after you signed. Because I know for me, fear is just, it's like, I don't know how to describe it, but fear goes away when you take action. It's just the most amazing thing. And it feeds itself, like success breeds success. But if you could go back to your first investment, I want to help people as much as I can here to kind of go through that step, or those emotional steps, if you don't mind sharing.
Oh yeah, absolutely. I mean, I was nervous. I mean, I was really nervous. I consider myself a conservative investor. And I was nervous. And during this time period, we were able to, receive a pref of, I think, like 10 at the time. It was like 10 to 12, which is like unheard of these days. But but the lender at the time allowed some of that capital come back to us during the building phase. And the largest investor in the group was the developer. So that, any deal that, if you're doing large syndications, you always want to ask, it's always good when the operator has the most amount of money in the deal and they're investing right beside you. But I was nervous and skeptical.
Yeah.
And, it probably really wasn't until the second deal that I realized what was happening. So this is pretty cool. You get some money back tax free because it's a refinance, and then you redeploy that because you have your day job, which is producing a pretty good income. So as long as you don't need that money here and now, and you don't go spend it on a car or vacation house or something.
Yeah.
You can scale pretty quickly.
Yeah.
But yeah, I was nervous at first.
Yeah. Well, I know the funny thing for me is when it actually worked. I mean, like, I got my first property and then right away we're cash flowing. And the irony was 2 years later, I bought my first property with my college roommate. His name's Socrates, and his dad was a Greek immigrant. He helped us learn how to invest. Not too far from here, Virginia Beach, Virginia is where that was. Okay.
Mm-hmm.
Probably 5 hours away from me. And he, he didn't give us any money. He didn't give us the fish. He taught us how to fish. Right. So in any case, 2 years later, and we're young boys, we're 23 years old, living at the beach with our first professional jobs, making money. And I remember at the closing table, he's pounding his chest saying, if you boys do what I tell you to do, you won't have to work for anybody when you're 35 years old. But when you're 23 living at the beach with some money, we're like doing everything except what Mr. Nemeth wanted us to do.
Right.
So I eventually got married. Socrates bought me out. So I had about 3,000 into it total, and I got about 8,000 out in 2 years time frame. And while we lived there, our expenses were paid because we rented the other 2 bedrooms out to 2 other renters. I mean, I'm like, this is like, I was like, is this how easy it is? No, it's not always that easy, but when you apply the principles and you do have some skin in the game, I promise you're going to be far more successful. So if you wouldn't mind, Stephen, take us forward, like the time frame when this all occurred, like your first property to now, and your projectile of growth. Like, was yours more like a curve, starting off slow and picked up steam over time, or was it more direct? Or kind of describe that growth curve relative to the time frame. Like, when was your first one, and how many purchases have you done since, that kind of thing?
I probably have over 20, 25. I don't know. I mean, I'd have to look, but there's the growth curve is exponential, so, cause like what happens, or at least is what's happened for me, is when you get, when you do a deal and then a couple years later, you get some of your capital back. When you improve it or force depreciation, you cause the value to go up. Then you get a chunk of money. And then I have another account where all the rents and all the money just kind of flows into, and then you just have money just sort of piling up, just waiting to deploy it into the next deal and then the next deal. And then it just, like, as you go, it just, it just escalates. And then the other thing that's really neat that I didn't realize I really didn't understand this till later, is the tax code is written for two types of people: the informed and the uninformed.
Mm-hmm.
And our government really wants. There's two things. If you look at the tax code in terms of what is favored in our tax code, it's housing. Real estate wants housing for its people, and it wants energy.
Mm-hmm.
And those are the two things that they don't care if you're the best plastic surgeon or the best CPA and you make 10 million. They love to partner with you along the way and tax you at the highest possible tax rates. Excuse me. But when you invest in real estate the right way, a lot of that income that you get, that passive income, is tax sheltered. Usually I'm not a CPA, but usually, for about 5 years.
Yeah.
And that's really powerful, is the tax benefits of real estate investing that the stock market and other forms of investing just really
Right.
can't reach.
Yeah, I agree. I appreciate you sharing that too. I know when we spoke the other day, we talked about investing inside self-directed IRAs, and we're very big proponents of that. In fact, the 3-day event, I put on 4 3-day events every year. I did 6 last year, but a lot of work. So we're gonna do 4 this year. But I always have a special speaker come to talk just about investing inside a self-directed IRA, and it's such a powerful tool, especially for people like us that have I own other businesses too, and most of the people I work with own, maybe an engineer who owns his or her own HVAC business, or like yourself, a dental practice, or a chiropractor owning her own chiropractic practice. The benefits are compounded when you have your own business, because I don't want, we could spend 3 days talking about this, of course, but just know this, guys. Use Stephen as the example and the model. And for everybody listening, I promise you, I did invite Stephen to come to one of our 3-day events. We just got to find one that's closer to home. I'm in California right now, and of course he's in North Carolina. We'll do some East Coasters towards the end of the year. But it always helps to network with others who are doing what you want to do, particularly when they're in the same space, the same business space. There's accountants, there's doctors, there's pilots, there's teachers. When you're hanging around people that are other dentists or chiropractors, similar related fields, there's a lot of synergy there, and you'll find yourself doing joint ventures. I know for me personally, my biggest purchases were with partners. I can participate in much bigger projects. Have you found that to be the same thing, Stephen, with you? Have you done?
Oh,
yeah.
I would say, you can own a small part. You can own a small part of a really big project, or you can own 100% of a small deal. And that's sort of how I look at it. And I look at it, whenever you own a small percentage of a large deal, you got a lot more scale, and you got you reduce your risk. And that's sort of my preferred method, way to go.
Yeah, I like it. So, hey, let's talk about this. I know people are listening to this from all over U.S. and Canada, even overseas, believe it or not. But is your investing? Did it start off being concentrated around that Raleigh, Durham, Greensboro area of North Carolina? And if so, that's okay. I mean, that's what I did for years. But have you also expanded and participated in other projects in different locations, different areas?
Oh, that's a great question. Actually, let me think. I don't have anything in my local market.
Wow.
And there's a few apartments in North Carolina and South Carolina, but most of the stuff I have is in the Southeast. But as far as Texas, but I'm sort of spread out. But it kind of goes back to being in the right rooms, knowing the right people.
Yeah.
In general, I don't want to get political here, but I like to invest in red states. The things that are owner friendly, not too tenant friendly. Some of the places, if you're in a place that is super tenant friendly, you could have a really hard time, kicking somebody out. Or if you're, loaning money in the lender, you just want to be in investing in a state that favors you.
Yeah.
So in the best position. And there's so many deals and so many things out there. That's sort of, how I wrap my head around it. But in general, my philosophy is I try to lend money in self-directed IRAs because that compounds tax-free,
Yep.
and leverage outside. That's probably the simplest sort of formula, that has been taught to me. Because then when you leverage pre-tax money, I don't want to get into the physics of it, but there can be tax consequences. So, but in general, lending, in self-directed IRAs to professional flippers is, pretty cut and dry, pretty black and white. But the downside is there's no leverage with that. I mean, you have to have the cash.
Right.
To lend, $100,000 on a flip or whatever.
Yeah. Well, at the same time, though, you're actually, like you said, you lend from inside the self-directed IRA and you leverage outside. So you could, if you're investing your money in multiple ways for multiple structures, all of that, and I'm not saying spread yourself so thin you can't keep track of all your stuff. But what I'm saying is there's a lot to be said for having at minimum 3 different ways of earning passive income, right?
Right.
And I know people will say, I mean, at one point when I first joined, the GoBundance mastermind group that we're both members of, I had over 80 streams of income, 82 to be exact. I'm much more streamlined now, but I'm also, older, wiser. My children are grown and out of college, got their jobs, got their houses, they're married, and the bank of Gary Wilson's been closed. So, but I've always been conservative like you, and I'm not saying I'm more conservative now. It's just the reflection of where I am in life and my lifestyle. And you know me, I get to pretty much be perpetually in vacation when I'm traveling all over. I'm in California right now, one of the most infamous, tenant-friendly states. It's not the most tenant-friendly, though. There's some others that are more tenant-friendly than even California. Canada, for example, the entire country, and I'm not knocking Canada. I believe my wife's Canadian. For everybody listening here, just know this: when I'm off the road, half the time I'm in Canada. But just try to in Montreal, like Toronto, the landlord-tenant laws are very, very pro-tenant. And I understand the logic behind it all, but it does make it a challenge for the owners. It's like we lose a lot of our ownership rights or have lost them over the years. So a lot of Canadians will come down here in the States and invest. It's just, my gosh, you go to even Pennsylvania is more owner friendly. Well, eastern half of Pennsylvania is more tenant friendly. Western half of Pennsylvania is more owner friendly. But my gosh, you go down into like Florida, Georgia, Alabama, Mississippi, Texas, Oklahoma. Believe it or not, Utah is a great state. Arizona is a great state. I mean, even the Midwest, like Illinois, Indiana, even Ohio, and even Michigan, are all great places to own real estate. Illinois has gotten a little bit tougher over the years, but there's so many places. And I want to kind of touch on this for just a second for everybody listening. When I first started investing, guys, I didn't go outside my area. I mean, I can't even, I think it was like 17 years before I finally went outside my area. And now I'm comfortable investing literally from California to Maine and Montreal to Miami, because I know how to look at the properties. The fundamentals never change. So that's one good news. Is fundamentals are the same wherever we go. It's just the markets are different. So you need to know what strategies to apply to the different markets. Some markets were playing more on appreciation. Some markets were playing more on cash flow. But if you could, Stephen, I'm glad we talked about the areas a little bit, and I'm glad that you're investing in multiple areas, because it really does. I think a lot of people are thinking, I want to go drive by and see it. I used to feel the same way, but it's not necessary. But what I want to just talk about now, if you don't mind, we've got a few more moments here. Is there a particular strategy that you favor more than others, or maybe describe your favorite deal? And what strategy did you use? Even if it's a simple strategy, that's great, because I've found out in my experience, the simpler the better. So anything you pops into mind there, one of your favorite ones, or a particular technique?
It depends on where we are. Like right now, where we are in the cycle, I'm turning down, development deals. I'm looking at what we've exited some deals at. is what people were building costs, going into some deals, just some of the things that come across my desk. But, I like, you got to look at, I look at the, what's the population growth. There's got to be people there, and I, should be going up. And, job, do the job support, that particular market. But, one of the things I like are value add syndications, apartment syndications, 100 units plus, so that there's on-site property management, you have built-in scale, and it needs, it's a mom and pop, operation, and they haven't been running it properly and need some love, fix the place up, and then refi in a couple of years and get the capital back and redeploy and just rinse, lather, repeat, and just keep on, doing that. And that's probably one of my favorite things on the outside of a tax protected environment. And then within the tax thing, I like lending. I like being in the lender position. I did this one deal in Florida, and with it all goes back to being in the right rooms and having the right network. But we had a lending deal where we had a quitclaim deed, already signed, and the attorney, the other attorney had it. So, if the flipper, didn't pay or whatever, we were ready to take the property.
Yeah.
And, but, so I always look at, what's my downside. And those are probably my two, favorite things right now. It's just lending, my dad has some health issues, and I've taken over their IRAs for them. And what's kind of neat is I've generated enough, I am generating enough income through my network and people I know, so that when he does have to go into memory care one day, it's, the IRA is generating enough income to cover, all those costs. So
right.
It's pretty powerful to know this stuff.
It is. The other thing about investing from inside a self-directed IRA is there's additional protections, as shields against liability, because it's what you have in there is inside the self-directed IRA. And, people can, let's say somebody decides to file a suit, they can pretty much get a charging order, but just like our 401ks for the employees out there in the world, your retirement funds are pretty well shielded from lawsuits, pretty well protected. So there's a lot of advantages other than the financial advantages. That's why it's a little more costly, like structurally, but I think the benefits far outweigh the pros far outweigh the cons. I guess is what I'm saying. And obviously you've discovered the same thing. So
well, the other thing I've recently discovered is that I was a stock market investor along the way, because that seemed like that was less headache, and I had a lot of money in the stock market. And you'd hear the market went up X percentage for the year, and your account statement never just quite seemed to match up. And I'm a little slow, but it's taken me a while to figure this out, that they can kind of cook the books legally. And like if you had your portfolio went up 20% one year, and then you gave it all back the next year, they report average returns. You'd have an average return of 10%, but you're back at zero. But
exactly.
That's how returns are reported on Wall Street. The stock market does on average 8 to 10% a year.
Yeah.
But it's not an aggregate. It's not a real return.
Yeah. Well, it's funny you mentioned that, because back in the big recession, I had a number of Wall Street guys approach me to deploy their financial assets, and they were basically running from the stock market. And these were seasoned veteran pros. I mean, I'm thinking, geez, if these guys are vacating, what chance do I have? But real estate, the big difference is it's a tangible asset. That's the fundamental difference. If you don't have to sell, you really don't care what the economy's doing. And let's face it, in a recession, more people become renters. So there you go. It's like you got natural built-in hedge against recessions and stuff. Now, the last recession was very unique because it was driven by real estate. Most of the recessions are driven by other factors, and real estate kind of lags along a little bit. But so that was very unique, very different, but still the same opportunities there. It was like Christmas time. I was on a cash basis, and I just, you learn whatever there's adversity, there's opportunity. But if you could, Steve, we're getting close here, but if you could share a little bit about what makes you tick. I know you're obviously you're a family man. I appreciate you sharing that in the beginning, but like you've got some family experience. Your parents invested too. But is there something in particular that like drives you when you get up in the morning? If you know you're going to engage in that activity, it's like this is going to be a great day. And it maybe related to, particularly with investing relative to your practice. Like, do you see yourself going forward? This is a two-pronged question, by the way. I've had a lot of people who own their own practice come to me and say, well, I want to buy a bunch of real estate because I want to get out of my practice, and my practice is my name, so I don't think I'll be able to sell it and all these things. I disagree, and I got some good examples where people were able to leverage their business, like because it's structured as a corporate entity, LLC, S corp, whatever. To get a business loan against the business, the practice, to then give them seed capital to start investing in real estate. Well, over time, the real estate grows, and that becomes the foundation upon which you can do other things, like maybe grow your practice and hire a recent college graduate to take your appointments and things like that, so you don't have to sell the practice. It's just you step out of the primary role. But in any case, I'm starting to talk too much. I want to have you talk about that, and have you thought about that, and can you see how real estate is now enabling you to think along those lines?
Well, I think it's definitely compatible. I would say that the first engine is your business, is your practice. So that's going to give you, like in real estate, we can get, I don't know, 10, 12, 15%, 20% returns, whatever. And those are great. I'm not knocking those returns, but nothing will have a better impact than working on your business, not in your business.
Yeah.
So let's say you were thinking about putting $100,000 into a deal. Well, if you invested $100,000 into your business, whether it's coaching, marketing, becoming better at a business, hopefully you get a fivefold, at least a fivefold increase from that type of investment.
Yeah.
And that would provide so much capital to do, whatever you wanted to do. And that's kind of what I did. Is the problem in dentistry is they teach you, dental school, they teach you how to, be a professional and how to do a trade, one way, but they really don't teach you how to run a business. And most people, the business runs them. So I flipped that with some help and coaching. I didn't figure all this stuff out. And so I was able to take my practice to new levels, which provided capital to do, a bunch of deals. But I think Tony Robbins summed it up. He calls it R&D. And you were kind of alluding to it. If someone else is already doing it, you can just R&D, rip off and duplicate.
That's it. Hey there.
So, if other people are doing it, just model them and just do what they're doing. Kind of like, what you're saying, and don't reinvent the wheel. Your sample size, when it's just you, is just yours. You have a sample size of one. And that's what my parents had. They had a sample size of one. That's all they knew. But, through meeting people like you and, being in the right rooms, I now realize what's possible, and don't reinvent the wheel. Just, hey, what are you doing? Like, how did you do that? And just do what they did.
Yeah. Success leaves clues. And boy, I'm so glad you mentioned, you've obviously invested in your own self through training and coaching and mentoring. And I did the same thing after years of thinking like this, how hard can this be? I can do it on my own. Man, perfect example. My first 10 years investing, I bought exactly one property. Finally paid for a mentor, paid him $1,000 a month. In that first year, I got 10 properties. So, 10 years, one property, do it on my own, get the right help, 10 properties 1 year. Huge difference, So everybody listening, and I think I speak for everybody, Steve, when I say we thank you from the bottom of our hearts. I think you just sharing your experience for the last 35 minutes is probably going to help a lot of practitioners around the U.S. and Canada. see themselves taking that next step forward. Perhaps you guys get to meet each other one day at one of our events. So for those of you listening, just remember, go to myinvestedservices.com. Join the community if you want. There's different levels. Just go in at the easiest level. Just put your toes in the water and get started, so you can start meeting people who are doing this in your field around the country, and put yourself in a position so that you're not stuck behind the chair. And go ahead and subscribe to the podcast. And Stephen, once again, man, thanks for doing this. Big help, brother. And I'm gonna go ahead and turn this off. But in the meantime, God bless you. God bless everybody and your families. And we will see you on the next podcast. Okay, bye-bye.